Prepayment risk is a risk associated to the event that a mortgagor will repay part or the entirety of its loan before the agreed maturity.
Prepayments make the duration of a portfolio stochastic, involving mainly two risks for the bank: interest rate and liquidity risk. It's crucial for the bank to be able to predict the magnitude of this risk and act accordingly.
Moreover, the possibility of early prepayment is legally allowed in many countries, and clients usually have the opportunity to exercise it without any fee.
The reference quantity, which is analyzed in order to describe the prepayment phenomenon, is the conditional prepayment rate, referred to CPR for short.
The CPR is defined as a ratio between the principal cash flows whose early repaid in a given time interval and the total outstanding amount at the beginning of the same interval.
The problem of forecasting can be seen as the pricing of embedded options of prepayments. Unfortunately, we cannot use the canonical approach of credit risk.
This is because retail clients do not have high financial knowledge and might not act rationally. The idea is to use a behavioral model.
Our model should strike a balance between accuracy of the model in sample data, achieved by more complex modelization, and the precision of future projections of CPR, obtained by reducing the number of stochastic features.
To achieve these results, a random forest approach is used to determine the lowest number of features to be able to accurately explain the phenomenon.
We use these notions for the implementation of a neural network. Neural networks are computational systems which try to roughly mimic the networks of neurons in a biological brain.
A big advantage of this method is that it uses basic and not computationally expensive operations to solve complex problems that are not linear nor mathematically well posed.
We employed the simplest one, which is called the sequential model, that we decided to compose by one input layer, two hidden layer, and one output layer,
where we set specific hyperparameters, such as the number of neurons, the learning rate of the optimizer, and the dropout rate, by tuning our model on the specifics of our analysis.
Eventually, the model is tested via an application on a sample of mortgages on a 12-year time window.
In the end, we obtained a neural network model which is able to predict the trends of the CPR curve.
Moreover, we confronted our results to the ones obtained through a more standard approach, the logistic estimators.
We can observe that the neural network outperforms the logistic regression, being more accurate on our test data and having a better response on the spikes of the real CPR.
We can conclude that the best way to accurately predict conditional prepayment rates is with our implemented network.